Every second, somewhere in the world, a stock price moves, a trader buys, a seller panics, an algorithm calculates. To most people, these are just random blips, noise on a screen. But professionals, they see something else, a pattern, a rhythm, a heartbeat. Because markets don't move in straight lines, they breathe. They inhale optimism and exhale fear, over and over again. Every crash you've ever heard of, every bull run that made headlines, every fortune built or lost was simply another tick of this hidden clock. This isn't about guessing, it's about alignment. Because those who align with cycles move faster, smoother, and wealthier than those who fight them. Class begins. The market, like the human mind, moves through 4 emotional phases: expansion, euphoria, panic, and recovery. Each phase has its signs, its psychology, and its traps. And once you recognize them, you'll never look at markets the same way again. Let's break them down one by one. 1. Expansion, the season of growth. This is where it all begins. The economy is improving, employment is rising, inflation is low, interest rates are stable, businesses start investing again, consumers start spending, investors start returning. Example: between 2003-2007, India's GDP soared, IT boomed, and stocks quietly tripled before the media noticed. In 2010-2013, post the global crisis, those who bought when the world was fearful caught the decade-long tech boom. Expansion rewards foresight, not frenzy. 2. Euphoria, the season of mania. Then comes the dangerous phase. Euphoria. Growth turns into greed. Media celebrates record highs. Everyone suddenly becomes an expert. Valuations detach from reality. New investors enter, not because they understand, but because they fear missing out. Example: 1999 dot-com bubble, when companies with no revenue were valued higher than IBM. 2021 crypto and meme stock boom, fortunes built in months, then erased. Euphoria feels euphoric until it doesn't. Then the clock strikes midnight. 3. Panic, the season of fear. When greed flips to fear, liquidity vanishes overnight. Everyone wants to sell, no one wants to buy. But professionals, they're watching, not reacting. They know fear is temporary, that every bear market plants the seeds of the next bull. Example: 2020 COVID crash, 40% drop in 40 days, followed by the fastest recovery in history. Panic is not a signal to exit, it's a signal to observe. 4. Recovery, the season of renewal. This is where new market cycles are born. Interest rates stabilize. Earnings improve. Capital starts flowing again. The investors who rotated into strong assets during the panic now lead the next expansion. Example: those who bought during 2020's fear, tech, energy, healthcare, enjoyed one of the strongest bull runs of the decade. The wise don't predict cycles, they prepare for them. Because while others chase tops, professionals chase timing alignment. Have you ever wondered, when the stock market crashes, where does the money go? When gold rises, when property falls, when bonds rally, what's really happening underneath? Here's the truth. Money doesn't vanish in markets. It migrates. The law of financial energy. Think of global money as a giant current of energy. It can't stay still. It moves constantly, seeking balance between risk and reward. This movement forms a predictable rhythm across 4 major asset classes. 1. Expansion phase, the rise of equities. When economies are healing and optimism returns, the first place money flows is into stocks. Why? Because businesses grow fastest when capital is cheap, inflation is low, and consumers spend freely. Example: post-2009, central banks lowered interest rates to near zero. 2. Euphoria phase. The real estate and luxury surge. As stock profits multiply, people feel wealthier, and wealth always looks for tangible expression. Money begins flowing from stocks into real estate, automobiles, and luxury. Home loans rise. Urban property prices spike. Builders and auto companies thrive. The middle class starts leveraging, buying homes, cars, and lifestyle upgrades. Example: between 2003-2007, after the equity rally, Indian real estate doubled in major cities. 3. Panic phase. The flight to safety, gold and bonds. When panic strikes, liquidity evaporates. Stocks fall first. Real estate freezes next. That's when money rushes into safety assets, like government bonds, cash, and gold. Because when fear spreads, people stop seeking growth. They seek survival. Example: during the 2008 crisis, gold rose 25%, while equities crashed 50%. 4. Recovery phase. The bond-to-equity transition. Capital slowly leaves bonds and gold and returns to equities and new growth sectors. This is where the next market cycle begins, quietly, before headlines notice. Example: in 2020, as interest rates hit rock bottom, money rotated out of gold into tech stocks, fueling a 100% rally in 18 months. Wealth isn't destroyed in bear markets, it's transferred from the unaware to the prepared. Every investor wants to grow rich. But the rich, they want to stay that way, because building wealth is a sprint, but keeping it is a marathon. That's why the world's best investors don't build portfolios for bull markets, they build for all weather. In 1970s, America, a young trader named Ray Dalio made, and lost, a fortune trying to predict markets. After being humbled by a crash he never saw coming, he asked himself a question that changed investing forever. What if instead of predicting the weather, I built a portfolio that survives every season? And that's how the all-weather portfolio was born. The idea is simple. Every market condition benefits some asset class. So instead of betting on which one, you own all the seasons, in the right proportions. The secret isn't in owning the assets, it's in rebalancing. Once or twice a year, professionals. Trim winners, sell high. Add to laggards, buy low. This keeps risk constant and emotions out of the equation. Example: in 2020, gold spiked and stocks fell. Rebalancing moved profits from gold into cheap equities. Rebalancing is emotional jujitsu, turning volatility into virtue. The wealthy don't diversify randomly. They diversify intelligently. They build portfolios for resilience, not reaction. They measure success not in percentages, but in consistency. The question every investor asks at some point is, when do I buy? When do I sell? But the world's best investors rarely ask that, because markets don't crash suddenly. They deteriorate in silence first, in data, in liquidity, in psychology. Professionals don't trade news, they trade transitions. Because markets don't crash suddenly, they deteriorate in silence first, in data, in liquidity, in psychology. Professionals don't trade news, they trade transitions. 1. The interest rate compass, the pulse of money. Interest rates are the heartbeat of the global economy. When central banks raise rates, they're telling you, we're tightening the flow of money. When they cut them, they whisper, "We're scared." Professionals watch this more than any price chart. Example: in 2003 and 2009, when rates dropped, liquidity surged. Markets began decade-long bull runs. 2. Liquidity and credit flow, the oxygen of markets. Imagine the economy as a body. Liquidity is its blood. As long as credit flows freely, markets breathe easy. When it clots, panic begins. Professionals track bank lending rates, bond spreads, and global liquidity indicators, like the US M2 supply. Money doesn't vanish, it suffocates or flows. Watch the oxygen, not the headlines. 3. Earnings versus expectations. The disconnect indicator. Stock markets don't react to earnings alone. They react to surprises. Professionals track this expectation gap because cycles often turn when the majority's assumptions collapse. Example: in 2009, after brutal declines, companies still posted losses. But losses were less bad than expected. 4. Sector rotation, the canary in the coal mine. The first sign of a cycle turning isn't in indices, it's in sectors. Watch which sectors lead and which begin to weaken. Early signs of cycle tops. Defensive sectors, FMCG, pharma, start outperforming high-growth names. Cyclicals, autos, infra, real estate, start slowing down. Early signs of recovery. Banking, IT, and mid-caps quietly bottom out. Market breadth widens before index recovery. 5. Investor sentiment, the human signal. No indicator beats the psychology of crowds. Markets peak when everyone feels invincible. Example: in 2021, record retail inflows and meme stocks screamed euphoria. Smart investors build intuition through repetition. They don't guess, they feel the pulse. Because the more you study cycles, the more they start to rhyme. In every market crash, those who react and those who remember. The first group sees the end of the world, the second group sees the beginning of wealth. Because recessions don't destroy fortunes, they transfer them from the emotional to the enlightened. 1. The fear reflex, the brain's default setting. Let's start with truth. Your brain isn't built for investing, it's built for survival. Example: in March 2020, when the world locked down, most retail investors sold everything at 30–40% losses. By August, markets had recovered. Fear made them exit just before the rebound began. 2. The psychology of professionals. Calm in chaos. Professionals experience fear too, but they've trained their response. They don't ask, "How bad is it?" They ask, "How cheap has fear made it?" When others see fire, they see clearance sales. Example: in 2008, Warren Buffett wrote, "Be fearful when others are greedy, and greedy when others are fearful." 3. The emotional cycle of every investor. Every human rides the same curve, but professionals recognize where they are on it. Professionals invert this curve. They buy in despair and sell in euphoria. That's not contrarianism, that's emotional literacy. Markets reward those who manage themselves better than their portfolios. The behavioral toolkit: how to train your mind like a pro. If you want to survive and thrive through recessions, you must treat emotional discipline as a skill. Here's how professionals do it. A. The pre-commitment rule. Decide in advance what you'll do when fear strikes. Predetermine allocation thresholds, rebalance dates, stop loss, or buy zones. Then when chaos arrives, you act on your plan, not your panic. B. The data anchor. Keep a simple crisis dashboard, past recessions, their durations and recoveries. It reminds you that every storm passes. Example: 2008. Crash minus 55%, recovery in 24 months. 2020. COVID crash minus 38%, recovery in 5 months. History is not prophecy, but it is proof. See the noise filter. During crisis, mute 90% of information sources. The louder the media gets, the less actionable the truth becomes. Follow data, not drama. The professional advantage is not intelligence. It's emotional symmetry, the ability to feel fear and act rationally anyway. Because markets don't test your knowledge, they test your nerve. In every storm lies a silent opportunity, and those who stay calm hear it first. If this series gave you clarity, subscribe to @Value Over Vanity, where I give away for free what others charge fortunes to teach. Comment: My flywheel begins today. Because in a world obsessed with speed, we choose value over vanity.